Hello everyone. In this video, I will be discussing market risk. Market risk for financial institutions arises when financial institutions actively trade assets and liabilities rather than holding them for longer term investments, funding, or hedging purposes. Market risk is closely related to interest rate risk, equity return risk, and foreign exchange risk in that as this risk increase or decrease, the overall risk of the financial institution is affected. However, market risk adds another dimension resulting from the financial institution's trading activity. Conceptually, a financial institution's trading portfolio can be differentiated from its investment portfolio on the basis of time horizon and secondary market liquidity. The trading portfolio, often called the trading book, contains assets, liabilities, and derivative contracts that can be quickly bought and sold on organized financial markets. The investment portfolio, on the other hand, contains assets and liabilities that are relatively relatively illiquid and held for longer holding periods. With an increasing securitization of bank loans, more and more assets have become liquid and tradable. And of course, with time, every asset and liability can be sold. While bank regulators have normally viewed tradable assets as those held for time horizon less than 1 year, financial institutions take an even shorter term view. An extreme case of the type of risk involved in active trading is, of course, the global market meltdown of 2008-2009. As US mortgage borrowers defaulted on their mortgages, the US financial institutions that held these mortgages and mortgage-backed securities announced huge losses on them. It is these securitized loans, and particularly securitized subprime mortgage loans, that led to huge financial losses resulting from market risk. Banks, investment banks, and securities firms in the US and elsewhere were major purchasers of mortgage originators in the early 2000s, which allowed them to increase their business of packaging the loans as securities. As US mortgage borrowers defaulted on their mortgages, the securitized mortgage market froze and financial institutions were left to hold the toxic subprime mortgage assets at hugely reduced market values. US investment banks were particularly hard hit with huge losses on the mortgages and securitized backing them. In September 2008, Lehman Brothers is a US investment bank with a history of more than 158 years, filed for bankruptcy. Merrill Lynch was bought by Bank of America. AIG, which is one of the world's largest insurance companies, met with US regulators to raise bankruptcy. Desperately needed cash, and Washington Mutual, the largest saving institution in the US, was acquired by JP Morgan. So these are some examples that how these institutions were hard hit from market risk. The GFC illustrates that trading or market risk is present whenever a financial institution takes an open or unhedged long or short position in bonds, equities, and foreign exchange, and prices change in a direction opposite to that expected. As a result, the more volatile the asset prices in the markets in which these instruments trade, the greater are the market risk faced by financial institutions that adopt open trade positions. This requires financial institutions, managements, and regulators to establish control to limit positions taken by traders, as well as to develop models to measure the market risk exposure of financial institutions on a day-to-day basis. We will be discussing more detail about the measurement of these market risk models in future weeks. Thank you very much.